Most investors operate under a simple assumption when they open a taxable brokerage account. They see a dividend payment arrive in their account and they click a button to reinvest it immediately. It feels like the right thing to do. It feels like compounding is working in their favor. It feels like setting a thermostat and letting the house warm itself. But in a taxable account, this automatic behavior is not a neutral action. It is a financial decision with tax consequences that can quietly erode your wealth over time. We need to reframe this not as a default rule, but as a strategic choice that depends on your specific tax bracket, your cash flow needs, and the current valuation of the market. If you ignore this, you risk falling into what we call the dividend trap, where the dividends you rely on drag your returns below the rate of inflation. Here is the thing that most people miss about dividends. When you receive a dividend, the government views it as income in the year you receive it. Even if you do not touch that money, and even if you immediately reinvest it to buy more shares, you still owe taxes on that distribution. This creates what is known as a tax drag. Imagine you are filling a bucket with water to represent your portfolio growth. Every time you pour in a dividend, you are adding water. But there is a hole in the bottom of the bucket that represents taxes. Every year, a portion of that water leaks out before it can even join the rest of the water in the bucket. Over 20 or 30 years, this leak can drain a significant percentage of your potential compound growth. The complexity deepens when we look at the cost basis. When you reinvest a dividend, you are buying a new share at the current market price. This new share establishes a new cost basis for your tax records. This is crucial because when you eventually sell that share, you will owe capital gains tax on the difference between the price you sell at and the price you bought it at. This creates a phenomenon known as the recapitalization reckoning. Essentially, you are deferring the tax liability, but you are not eliminating it. You are pushing the tax bill into the future. If you hold the asset until you pass away, there are specific rules that might wipe out that basis. But for most investors, that tax bill is a looming liability that sits on your balance sheet waiting to be paid. Now consider the impact of market valuation. Reinvesting dividends assumes that the market is at a fair or attractive price. If the market is historically expensive, reinvesting your cash into a portfolio that is already overvalued can lock in lower future returns. You are buying more shares at a high price point. In this scenario, holding the cash might be the smarter move. You can wait for a correction or a market dip before deploying that capital. This is where the strategic decision comes into play. You are not just deciding whether to buy more stock. You are deciding whether to pay a premium for that stock right now or to wait for a better entry point. The tax rate you pay on dividends depends heavily on your income level and whether those dividends are qualified or non-qualified. Qualified dividends are taxed at lower capital gains rates, while non-qualified dividends are taxed as ordinary income. If you are in a high tax bracket this year, taking the cash and paying the tax might be less painful than reinvesting and creating a future tax liability at a potentially higher rate. Conversely, if you are in a low tax bracket, perhaps due to a career break or a low-income year, realizing gains or reinvesting might be less costly. The timing of taxable events is just as important as the investment itself. This brings us to the concept of tax loss harvesting. In a taxable account, you can offset the gains from your dividends by selling other assets that have lost value. If you have a stock that is down significantly, you can sell it to realize a loss. That loss can then be used to cancel out the tax liability from your dividend income. This creates a dynamic where you are not just passively reinvesting, you are actively managing your tax bill. You are using the volatility of the market to your advantage. This requires active management and a deeper understanding of your portfolio than most investors possess. It means you are not just buying and holding forever. You are buying, holding, and occasionally selling to optimize your tax position. Let us look at the cash flow needs of the investor. Many retirees rely on dividends for income. If you need that cash to pay your bills, reinvesting is not an option. You must take the distribution. But if you do not need the cash, reinvesting might make sense, provided the tax drag is acceptable. The key is to align the reinvestment with your liquidity requirements. If you have a large cash pile accumulating from dividends, You can use that cash to buy more shares during market downturns. This is a form of dollar-cost averaging that happens to be tax-efficient because you are using pre-tax dollars to buy more shares, effectively lowering your average cost basis over time. Another critical factor is the specific share identification rules. When you sell shares, you can choose which specific shares to sell. You can choose to sell the ones with the highest cost basis to minimize capital gains taxes. This flexibility allows for strategic planning. You might decide to hold on to shares with unrealized gains for as long as possible to defer the tax. This is a strategy of deferral rather than elimination. You are betting that your tax rate will be lower in the future, or that the deferral will allow you to compound the money that would have otherwise gone to the government. Ultimately, the decision to reinvest capital gains and dividends in a taxable account is not a binary choice. It is not simply yes or no. It is a calculation involving your marginal tax rate, the valuation of the market, your need for liquidity, and your long-term horizon. Blindly reinvesting every dividend can lead to a portfolio that is heavy with tax liabilities and potentially overvalued assets. A strategic approach treats every dividend as a decision point. It asks you to pause and consider whether the market is offering a good value, whether your tax bill is manageable this year, and whether you need the cash flow. Thanks for watching all the way to the end. I am a one-person team working hard to make each video better than the last. Subscribe if you found value. It is the best way to show support. Drop a comment with your biggest takeaway. See you in the next video.